can see just in a few minutes on their phone. For our students, this is a great example of the Treasury responding to comments from taxpayers. And so you're seeing how the Treasury and taxpayers work right tonight, and hopefully this will be a great discussion. I'd also like to just thank a couple of people before we get started. Peter Connors is here representing IFA, and we're grateful to IFA for hosting this program and sponsoring a reception that we'll have after the program. Peter will have more to say about IFA, but IFA, the USA branch of IFA has about 1,000 members and 250 members in the New York region, which is the largest US region. Young IFA is a group that was established in 2005 to try to get people, like many of the graduates from our program, involved. And Peter will have more to say about this at the end of the program, as well as different events and competitions that IFA hosts. I'd now like to introduce our panel and then turn it over to them. Bob Stack, as I said, is the Deputy Assistant Secretary for International Tax Affairs in the Office of Tax Policy at the Treasury. He's responsible on behalf of the Assistant Secretary for the conduct of legal and economic aspects of tax policy relative to the representation of the United States in bilateral and multilateral relations with other countries. He also advises the legal and economic staffs within the Office of Tax Policy, other Treasury Department offices, and other government agencies. Prior to joining Treasury, Bob was the head of international tax practice at Ivins, Phillip & Barker. Lucy Farr is a partner at Davis Polk. Her practice concentrates on the taxation of corporate finance, derivatives, and structured finance, and on domestic and international tax planning for financial institutions. She's also done significant work representing investment funds and insurance companies. Jim Peasley is a partner at Cleary Gottlieb. He has significant experience guiding clients on the tax aspects of their major transactions, including capital market financings, mergers and acquisitions, joint ventures, and other matters. In addition to writing over 50 tax articles on different subjects, he is the author of Federal Income Taxation of Securitization Transactions, which is on the 4th floor of Vanderbilt Hall in the tax library. And finally, Willard Taylor has been of counsel at Sullivan and Cromwell since January 2008. He was a partner at Sullivan from 1972 through 2007. He's also a member of our faculty here at the law school, and this semester has been teaching a special course on payroll taxes and taxation of business conduits. And the last thing I'd like to say is just a big thank you to Willard for being the motivating force behind this panel and having the foresight to have it come out an hour after the issuance of the regulations. So with that, I'll turn it over to Willard and our panelists.
Actually, I disavow any connection between the timing and my efforts. We can talk about that as we move along. So what we're going to do, first of all, the slides really should be entitled Yikes. I don't have time to read them or something like that. But, what we're going to do is Lucy is going to go through the background to the proposed regulations. Jim, and they came out, as you all know, in April of this year, so almost exactly 6 months ago. Then Jim is going to go through the multitude of complaints that followed the issuance of the regulations. And then Bob is going to have an opportunity to talk as long as he wants about it. And if we have time, we will then review Jim's list of complaints against what the final regulations say. So with that, Lucy, do you want to?
Sure.
I think this panel is not going to lack spontaneity.
And I should say, I printed out the regulations, and you guys can see it, and brought them down, and we were just debating whether that would deter somebody from becoming a student from becoming a tax lawyer, but Jim pointed out that there will always be work for tax lawyers as evidenced by this, so that's the optimist view.
So you can tell us that no trees were harmed in the making of these regulations?
So just to make sure everybody has the background to follow along with the more detailed things we're going to talk about, I'll give an overview of how we got to this place. So as I think Willard was saying, the regulations were issued about 6 months ago, the proposed regulations. And what they do is they treat as equity certain financial instruments that would otherwise, but for the regulations, be treated as debt for tax purposes. And it is only applicable to debt issued between related parties. And we're probably going to refer to a related party group as an expanded group because that's how the regulations refer to them. So then, for those who are starting their tax law career, why do people care about debt versus equity? What are the key differences? The main difference, the most important difference, is that interest on debt is deductible by a borrower, whereas dividends distributed by a corporation on equity are generally not deductible. Further, if principal of debt gets repaid, then it's essentially a non-event, whereas the redemption of equity is treated as a dividend in the related party context, and generally then causes income. So that can be a big difference. Third most important, I think, is whereas interest paid by a U.S. member of a group to a foreign affiliate is generally not subject to withholding tax under tax treaties, that is not true of dividends. It typically is subject to, say, 15% or 5 or 10% withholding tax. So there's some circumstances in which a corporate group may prefer equity treatment rather than debt treatment, but on balance, debt is much more desirable. So recasting debt as equity within a corporate group of entities is a big deal. So under current law, or I guess I should say the law that existed before an hour ago, the debt equity determination was basically driven by a multi-factor test that was outlined in a whole bunch of cases. And so it was very difficult to administer and difficult for tax lawyers to, it still is, to interpret in many contexts, because you look at various factors and try to figure out whether it's more debt-like or more equity-like. A couple of important debt factors are, does the borrower have an obligation to pay a fixed amount? And does the lender have creditor rights? Those are debt factors. On the other hand, you have equity factors such as a lack of creditor rights, subordination to creditors, voting or other control rights, whether there is sufficient equity capital so that the company isn't too leveraged. And not only is this kind of a somewhat gray area of the tax law, but in the context of related party instruments, so one corporation issues an instrument to another corporation that let's say wholly owned, it's even more difficult to know how to apply these factors because related parties aren't acting at arm's length. So they don't necessarily behave the way a typical borrower and a typical lender would in the third-party context. So there's long been a lot of difficulty about how to interpret these authorities and figure out whether an instrument is debt or equity. I think I might skip over the Section 385 slides, or just speak to them very briefly just so we can get to Bob quicker. But essentially it's a statute that's been out there for close to 50 years. Treasury attempted to write regulations back in the 80s to interpret Section 385 because the statute gives Treasury the authority to issue more guidance on what's debt and what's equity for tax purposes. But that initial stab at writing regulations was unsuccessful, and the statute has just basically sat out there since then. And so what these regulations do is essentially provide guidance as to what is debt and what's equity in this context. So just a little background as to why these rules were issued and why now. I'll mention some of the stated rationales for issuing them that were described in the Treasury statement, the preamble that accompanied the proposed regulations, and that I think Bob and others have said publicly. Basically that the IRS has a lot of difficulty administering debt and equity determinations in related party groups because it's very difficult to audit them. It's hard to get all the documentation and information you need. The IRS has limited resources and the law is not clear. Plus, when you don't have third-party discipline in the system, when it's just related parties dealing with each other, they have the ability to manipulate the transaction in a way that might run contrary to tax policy. So I think those were mainly the stated rationales. Some of the undercurrent is you may have read in the news that a lot of U.S. corporations over the last 5 to 10 years have inverted, meaning they have been acquired by typically a foreign acquirer, and so instead of being a US-headed group, they become a foreign-headed group, and it's a little bit complicated how it operates, but the effect of that is to take a lot of income out of the US tax base and in a sense shift it to the foreign tax base, or sometimes it's not even taxed. And so there's been a lot of concern about inversions, and they've been attacked in various legislative and regulatory ways. But one aspect of inversions is so-called earnings stripping. And what that is, again, you picture your foreign-headed top company owning a now it's a US subsidiary. US subsidiary issues debt up to the foreign parent company and pays a lot of interest and essentially strips out its earnings out of the US tax base. So that's, in a nutshell, what earnings stripping is. And I think that kind of development over the course of the last few years in the law has particularly stimulated the Treasury to act. So I think with that, I'll mention, I guess, just very briefly, the key parts of the proposed regulations. We'll see that the final regulations are different in some ways, and then we'll go to Jim. So the proposed regulations had three main sections. One section, and it's actually second on my list here, is the documentation rule that basically, if expanded groups, so related party groups, did not properly document their debt instruments, so record when a loan was made, record when an interest payment was made, record how they determined that the borrower was creditworthy, and whether there was an obligation to pay a sum certain and creditor rights. If they didn't do that, then the debt instrument would become equity, basically automatically equity, subject to a pretty limited kind of inadvertent failure exception. The second rule referred to here as kind of the general rule or the funding rule, and this is the most controversial part of the regulations, was one that also treated as equity debt if it was issued in certain circumstances. The kind of most key circumstance was if let's say a subsidiary corporation distributed as a dividend, not cash, but a debt instrument. So it sort of created a debt instrument without any cash moving around, just a debt being issued and distributed. That debt would automatically be equity, subject to certain exceptions. There are a couple of other paradigm cases that were similar, and they also contemplated situations where debt was created among members of the related party group, but no real cash or kind of new funding occurred. That by itself might not have been so controversial. I think what was really controversial about the proposed regulations was sort of a backup to that rule that was and is referred to as the funding rule. And what it did was say, all right, instead of distributing a debt instrument, you, let's say, distribute cash, step one, and then a couple of years later, lend money down. So if you collapse those two events, it looks like the distribution of a debt instrument. The rule basically said any two events like that happen within a 3-year period were per se automatically treated as being one of these bad events that would cause the debt to automatically be equity. And I think what a lot of commentators pointed out is that's very broad. The third part of the rule, I actually put it here on the slide first, is the bifurcation rule, and that would have given the IRS authority to treat a debt instrument as partially equity and partially debt. I mentioned that third because it is not in the final regulations, so it probably doesn't merit a lot of further discussion. And so with that, I'll turn it over to Jim.
So what I'm going to do is just describe, first of all, in general terms, the reaction to the proposed regulations by Bernie Sanders and others. And then Bob is going to describe some of the changes that have been made, and just give us an overview of what's been done in response to the comments. And then what I'd like to do after that is we have a number of slides that discuss in more detail what some of the criticisms were of the specific rules. The discussion of the bifurcation rule will be relatively short, but the others are a little more nuanced. And so after Bob has described that and said whatever else he'd like to say about the process, we could come back and look at in more detail at some of the substantive criticisms and how the regulations deal with them, and some of the larger policy issues that they raise. So I think it's fair to say that the sort of business tax community just had a cat fit in response to these regulations. There was crying and moaning and pulling of hair, and it was really quite remarkable. I can only think of two other instances that where the reactions have been quite as strong. One was Notice 9811, which involved some creating Subpart F income in some hybrid thing that was very important and got killed because of Congress. And the other is something that Willard, I guess, is now teaching about, which is treating self-employment income for limited partners, members of an LLC. That also created a big to-do, and Congress stepped in and stopped it, as I recall. They haven't done that this time. They've threatened it a few times. They've sent nasty letters, but so far no response, no legislative response. So if you go and look at the comment letters, the tax notes has a very helpful list of substantive comment letters, and I say substantive because there were thousands of them, but a lot of them were along the lines of, you know, I'm a veteran, I go to the VA, they don't give me money, corporations should give more money, so let's have these regulations. And that's fine, that's a perfectly legitimate point of view, but I can't really say much about it, but there are a lot of those. The substantive, more substantive comments are about 125. Many of them were hundreds of pages long. Perhaps no one other than Mr. Stack here has read all of them. But you know, there was a fair amount of overlap.
To be determined.
Yeah. There were a number of you know, common themes, and almost all of the comments I would say were negative, with some exceptions. There were some comments from Bernie Sanders. He thought they were great. And from some academics who wrote a letter saying they were great. And other than that, not so much. I will say, though, two things about them. I think that while the tone of the comments is generally whiny and complaining, as is the tone of these slides, I think it's fair to say that most of the serious commentators acknowledge the problem that the IRS was trying to solve, and also acknowledge that there's an element of artificiality in a situation where a shareholder distributes its own note to its parent. And so I think most of the complaints were not aimed at that core fact pattern, but at the sort of collateral damage that was done in trying to pick up a larger group of transactions having that core transaction in mind. So I do think there's a kernel there where many people would have said, yes, there was something to address. And also there would have been a better way to address it perhaps, but not within the toolkit that the Treasury possesses. You will hear a lot about the fact that many of these problems could have been addressed through changing the earnings stripping rules. There are statutory limits on how much interest can be paid by a domestic borrower to a related foreign lender. But those changes haven't happened, and so the Treasury, I think, approach was to say, look, it hasn't happened, we have the problem, so we'll fix it this other way. Other comments, many comments complained about the short comment period. Nonetheless, there were hundreds of pages of comments written in response, and I think I tend to read most of those comments as saying that if you just keep deferring the comment period until the Trump administration, it'll never happen, and wouldn't that be good? And so maybe there's more to it than that, but I kind of doubt it. A number of comments made saber-rattling noises about authority, about whether the IRS had authority to adopt these regulations. And particularly for you who are new to the profession, this is going to be a hot topic as the years go on, because under a recent Supreme Court case, The Administrative Procedure Act now is said to apply to tax rules the same way it applies in other areas. And so tax lawyers are discovering that there is such a thing as the Administrative Procedure Act, and so is the Treasury. And so that is a hot area. And a number of people, and there's a recent case, Altera, where the IRS lost, had regulations which overturned because they didn't follow the right sort of procedures. So there's been a lot of focus on that in thinking about these regulations, and that may be one of the reasons why the preamble is 350 pages long, because the IRS and the Treasury now know that they have to say the right magic words. They have to say, I looked at this comment, I thought about it really, really hard, and here are the reasons why I'm rejecting it or accepting it, as the case may be. And they've accepted a lot of them here. But there's a constant theme there of a threat of attack on authority grounds. And then the last overall comment I'll make is that when most of us think about these rules in the context of the Internal Revenue Code and federal income tax law, there are state tax implications of these rules. And one in particular is that there's a very nice exception for loans between members of a consolidated group. And the federal government adopted that rule in the theory that, look, it's all one big happy family from our point of view, so debt equity, we don't care. But the problem is that a domestic consolidated group can include a number of companies that are not consolidated or combined for state purposes. And the states tend to piggyback on federal rules. So they might say, look, we had separate companies, we'll treat them the same way the feds would have treated them had they not been consolidated. And as I understand so one of the comments was fix it somehow, and one of the ways you could have fixed it is to have an exception for domestic to domestic loans. As I understand it, we don't have such an exception. So this problem will still be with us, and something we'll have to be contended with. So let me see. Let me say a couple more words very quickly. One is in terms of criticisms. One is that the rules depart from current law in ways not contemplated by Congress. And I think part of the complaint there is that 385 is about factors, and this approach doesn't look like it has factors that you weigh. The response to that is, well, we just have two factors, related parties and no new capital, so it is a factor-based analysis. Another general complaint is that the regs aren't well tailored to the problem. The real issue was inversions and in some cases repatriation planning. They were much broader than that. And another complaint was that the effective dates were too soon. And we can come back to these because they really do. They did address a lot of these issues, I think, and so why don't we turn to Bob?
So, Jim, are you ready for?
Yeah.
Yeah, so Bob,
So I didn't want to, there's a lot of material, and I want to be sure that we give it its due, but I also want to be sure that people can ask questions and things. So I'm probably going to move relatively quickly through what's in the final reg package. But I want to open up with just a couple of general points. First, I took this because Willard said it was a student event, and I thought it's just kind of the right thing to do to come and talk a little bit about how this process works, not just on the technical side, but this is a kind of one of those cool moments in tax when you've got this big issue, and to come up and talk to students seems like a really exciting and important thing to do. I will comment that, so there's a guy named Plum. What was his first name? Charles Plum, who wrote this article back in the 60s? William T. Plum.
Yeah, exactly,
And
yeah.
I carry it around with me, and I got so old that the associates I worked with began to make fun of me, but it is the Bible on debt equity, and I think it was published in the NYU Tax Law Review.
Yes.
And I had a very tattered copy of it. The headline for the students is, "You'll never be able to figure out the difference between debt and equity, no matter how long you try, because there is not an answer." And of course, what happened was the courts, with all its factors, were all over the place, and Congress said, here's a statute, Treasury, try to do something. And so the problem that we faced, so the first thing I want students to understand, coming from a policymaker, is when a policymaker is thinking about a problem, we have a toolbox that only has certain tools in the toolbox. We are not a legislature, and we have to go say, now, when we look at what's happening, a company can invert, and the day after inversion, strip out all of the interest by simply the magic of dividending a note to your parent at the highest amount that you can bear based on whatever the common law rules were and or 163J, this struck us as something that was giving away the U.S. tax base. And the policy folks, we work for the taxpayers. And so one of our questions was, what can we do to stop this erosion of the tax base? But not only in connection with an inversion transaction, but as folks have pointed out, this can happen if a foreign acquirer acquires a U.S. company, and old and cold companies in the United States that are foreign-owned can use these similar techniques. So you have this broad threat to the tax base. We work for taxpayers, and the question is, what do we have? And we had this 385 tool. And by the way, the Kraft case, that is kind of the first case of dividending a note in the 50s, was a domestic-to-domestic case because you could have one domestic company with an NOL, so it can take money all it wants, and you could have another profitable company that wants to strip. So you can have domestic contexts. And our core tool was these 385 rules that go through these factors. Now, what we did in the reg, I'm going to go quickly on the documentation, but let me come back to documentation. But let me stick with the -3, which is the core problem case, the core problem of the funding rule and the way Lucy described it. So what we were looking at then was, we said, well, if we feel pretty good, it's in the preamble, that we have this authority to think about factors and super factors, because the Congress said you can weight some more than others, and if you think about that, if you can weight some more than others, you can have super factors, et cetera. So we really came up with a kind of a two super factor approach. The first super factor is, as Lucy already pointed out, if you have related parties who own the equity dealing with each other, these lines, the practical, the legal and economic reality of a loan versus a capital contribution are practically non-existent. So that's big number one. But big number two, and even in the Plum article, there's always been in the tests a factor as to whether or not the borrower got any money. I mean, we all think of a loan as if somebody gave you $100 and you gave an IOU. We rarely think of a loan as, oh, I owe you $100. And yet, that was the base case that we were getting at in the -3 regs. Now, let me just say, we know for a certitude that among all the bright lawyers in this room, if we had written a rule that said, if you dividend a note, it's not going to be respected, that everybody in this room would have said, oh, I have an idea. I'll borrow $100 today and have a $100 note, and somewhere in the not-so-distant future, that $100 will make its way back to the parent as a dividend, and voila, I got around the rule. My high-priced lawyers, thank God for them, I now have the functional equivalent of a dividend of a note. So this saves you a lot of reading, because all the -3 rules do is it says, if you borrow $100 and the $100 gets back to either the parent or another member of the group, it doesn't work. And then there's other ways, of course. I'm in New York, after all, the home of the greatest tax engineering in the world. If it's not. So we had to come up with some things like, oh, okay, if we just said if you distribute the 100, you know what they would have done? They would have had that U.S. sub buy the parent's stock. That's something we call hook stock. Oh, that's economically meaningful. Now the subsidiary owns $10 million of the parent's stock, but they didn't dividend back the $100, and yet, voila, I've got interest deductions, again, in my U.S. company. So, and the next thing you might also have done is figured out a way to do some fancy reorg, so you kind of get the same effect. And what you're looking for at the end of the day, this is why you don't have to really read anything, what you're looking for at the end of the day is, did the deduction stay in the box where you really wanted the interest deductions, but the property was someplace where it didn't really matter to anybody? And the -3 regs can be boiled down to really that kind of a setup. Now, let me just go now back to documentation, then I'll walk through all the changes we made and why we made them. In the documentation case, we were really dealing there with something that was kind of more fundamentally to the IRS's need to enforce these rules, because it was their experience that you could go in and audit a company, and they'd be like, well, yeah, there's this thing on our books. Yes, we meant it to be debt. Well, did you ever document it as debt? Did you ever figure out whether the borrower could repay? So the -2 rules are really kind of housekeeping rules. Frankly, from my practice with large multinationals, I would have thought people were doing that anyway, documenting intercompany loans. And the criticism we got there was that the proposed regulation said if you didn't document within 30 days, it was equity. And I have to confess, I work for enough multinationals to know sometimes within a large multinational, you may not know that there's a new CEO within 30 days out in Bora Bora somewhere. And so the idea that you had to do this within 30 days was perhaps a bit draconian. And we've done 3 things in the documentation rules, then I'll move off them. First, like the transfer pricing rules, we said, so fine, go around the world, clean up your debt documentation, do it by the time you file your tax return. You should be able to go around, figure out where you have your intercompany loans, document them, do it by the time you file the return. The second thing we did was we were concerned that the proposed rules had this kind of per loan, bad document, cliff effect, it's equity. And so because our real goal is to create kind of good hygienes among companies, we said, you know what, if you have a general procedure of documentation for your loan program, one foot faulted alone is not going to mess you up. What we'll do is we'll kind of create a presumption against you, but you can still come back and demonstrate that that was nonetheless debt. But if you fall below a kind of a good housekeeping standard, like no one ever got the memo and you're not doing anything, then it's going to be easier for the IRS to say, you're not documenting anything, we're going to have a leg up on showing the equity case. And that was done with various
So just
presumptions.
to be
Yeah.
clear, that what you're describing is the new approach.
Yes, thank you. This is in the regs that came out.
The old approach was use.
The one presumption. So,
One meaning you only got to do it once, or?
if you fail, there's a,
You have to show you're basically
Right.
competent.
Right, you have to have a
yes,
history.
that's right.
And on the legal agreements, do you need a legal agreement for every
No,
transaction?
thank
So,
you.
Yeah.
No, so I always thought that was a bit of a red herring on the part of the business community, but you can have umbrella loans and master loans. It's a kind of a common sense approach, so that if you've got some kind of a program going and you want to say, here's generally how we're going to do our intercompanies, there's some provisions in there for those. Now back to -3 and some of the kinds of comments that we were getting, but I do want to go back to first principles. If you think about this project and you said our tool was 385, you might have thought, and this is really reflected in the proposed regulations, that it should apply to all debt in all places at all times. And that's how you can understand the proposed rules, which did that. I think the way to understand the final rules is the Treasury can step back and say, well, okay, that's fair enough, but does the tax administrator, in interpreting and writing the rule, have the ability to say, well, you know what, where the cost to the fisc is minimal, but the administrative burden is really high, can you have a different rule? And I think that the general approach of the final regulation is to look for the places where the effect on the fisc is not expected to be high, and at the same time, the administrative burden would have been great. There are multinationals out there with thousands of foreign-to-foreign subs, and if you're going to treat a loan between two foreign companies as debt or equity, the effect on the fisc is rather indirect. So the rules carve out any situation in which there is a foreign issuer. They're not in the rules, and they are reserved. That is to say, obviously future treasuries or IRS could come back and look at that situation. A second type of carve-out we did was for regulated industries. Think banks and their relatives, and there's a list of them in the preamble and in the reg of the type of regulation, because those are so heavily regulated with respect to their capital structure and what and whom they can lend to and under what circumstances, that to overlay the 385 rule seemed unnecessary again, I would say the burden compared to the effect on the fisc from those institutions. And so what the financial carve-out does is it basically looks at a big group of companies, and if your top company in the US is a bank that is on the list of regulated, specifically regulated entities, we're gonna let that whole group under that regulated bank entity out of the -3 rule, which is this one we've been talking about, although they still have documentation to do. But the point is that they're not gonna have to worry with the borrowing and the subsequent distributions in the -3 rules.
Does that apply to loans between foreign parents, banks, to US subs?
If the issuer is foreign,
No, issuer is domestic, but the lender's a foreign regulated bank.
it will key off the regulation of the US parent, not the foreign entity. In other words, if that US entity is itself a regulated, let's say, bank holding company, that loan will not be subject to scrutiny, even if the lender, the creditor
Because the
is
borrower
foreign.
is regulated. you're
Because the
saying.
borrower is
I see.
regulated, yeah.
Okay.
Now, also in this space, insurance companies are regulated differently. They're regulated not so much by this kind of slew of federal statutes, they're regulated by states. And so there, instead of letting insurers have this kind of umbrella from the holdco down, we say that any regulated insurance company, and there's some rules, it's gotta be like a real insurance company that actually insures like real third parties and things, that those will be out. But if they're in a group that doesn't have other insurers, those other entities may not be out. I see a question.
Just on foreign issuers, sorry to go back, but in this kind of section
Yeah.
of discussion, are they accepted from -2 and -3?
Yes,
Okay, and
Yes.
that's regardless, the fact sheet seemed to refer to foreign affiliates owned by a US multinational? but
yes,
This is just any foreign issuer?
yes, it is any
Okay.
foreign issue,
Okay.
yes. And also the fact sheet uses phrases like between foreign, whereas it's actually any foreign issuer, so if the
Okay.
foreign person lends into the United States, I'm sorry,
US lender, foreign
thanks,
borrower.
yeah, that's out as well. So all foreign borrowers are out, and thank you for that. So we, we took out the regulateds. Let me just go back. I'm just gonna try to do this in some order. We took out the, let me talk about the earnings and profits exception. So remember, the base case was you kind of borrowed 100, but the 100 makes its way back to the parent. Well, early on, we thought, if you did borrow 100, but the 100 that makes its way back to the parent, and this isn't really airtight from a theoretical point of view, but the idea was, if the 100 that makes its way back to the parent is from the taxed earnings in the United States, the earnings and profits, that we can let that go up. Now that does a couple of things. At first, it gives a little play in the joints, right? You didn't want these rules to be so tight and so rigid that literally every dollar was gonna be matched. So you wanted to have a little play in the joints. Second, we thought the earnings were kind of fair game to go back up without implicating the rule. But the problem in the proposed regs was, we said it had to be out of current earnings and profits. And of course, companies had problems like, number one, you don't know your current E&P until the year's over. But number two, they almost were leading to a situation where we were forcing people on an annual basis to distribute up their earnings and profits, or a note of their earnings and profits. So what we did in this rule was, we said, all your E&P post April 4th, 2016 can be distributed at any time to your parent entity without implicating the rule. Then you would have had another problem, right? Imagine if, I finished the rule, assuming that the E&P was earned in your company while you were a member of the same group. And the reason for that rule was, you didn't want to have companies with a lot of undistributed E&P creating a tax attribute that made them takeover targets. Say, oh, let's buy this company. It's got $1 billion of built-up E&P it didn't distribute. So we have a rule that when that corporate owner of that group changes, so we now have a new group, that E&P thing will disappear. Closely related to that, people asked about, well, isn't it a little unfair that you're just looking at my distributions and you're not looking at the fact that I might have contributed capital somewhere around the time that I distributed the note? So there are rules that let the issuer of the note take into account capital contributions. They're a little tricky and weedy, and don't make me explain them, because you want to watch a little bit the timing there, because you don't want to give people the opportunity to automatically undo a situation with hindsight. So there's a certain amount of ordering in those rules that will pay some attention to.
Can I just ask you about the earnings rule? You
Yes.
said if you have a group that remains in place, you don't have an acquisition, how far back do you go with earnings?
April 4th, 2016.
Okay, so you can't go back to historical earnings even though you have an affiliate.
That's right. And what did you mean by even though you have an affiliate?
Well, even though you haven't acquired anybody, the foreign parent has owned the domestic sub since 1913.
Oh, yes, that's right.
And has accumulated all these earnings over
Yeah.
the years, so it's really its money. It hasn't been
Yes,
bought.
yes.
Nonetheless, you're not letting them take that out.
That's right. And I got that question recently, and I said, yeah, but we're also not going to hit your loans before April 4th either. So it's they get kind of grandfathered on the good side, I think, of that rule as well.
And Bob, on the
Yeah.
netting point, I think one comment that some people had made, including maybe Jim, was, what about netting debt within a year? Because maybe that's
I
dealt with
think-
by short-term.
I'm sorry. I think there may be some
Okay.
netting of debt
Okay.
within the year, given the timing at which you determine an exchange occurs. But I don't have it right on the tip of my fingers. Yes.
Is there any adjustment to the fact that proposed regulations based on current year EMP? So if taxpayers have already made decisions now based on the assumption that they have a full year's worth of EMP, and now you're taking out the first 3 months?
So before April 4th, January 1st to April 4th, 2016.
Current EMP, not accumulated.
I'm not sure what the answer to that question is. I'm not sure whether we make you buy. I'm pretty sure that you would typically get reliance on the proposed regs. How we did it, I just don't have that on the top of my head. The other complaint we got was companies like to manage their cash by moving it all around the group on a regular basis. And we recognized that if you didn't have some flexibility for short-term debt and cash management, you were going to force companies into situations to do, let's say, outside borrowing and add expense, and there didn't seem to be a lot. The game might not have been worth the candle because it really wasn't leading to the kind of stripping that we were concerned about. But the problem, of course, is if you tell people, all cash pool lending is okay, people will tell you they use their cash pools to keep long-term permanent debt on their subs books. So what we needed to do was craft some rules around how to police the fact that you've got short-term debt. And here, I'm going to do this a little bit from memory, and I'm not going to be as precise as I probably should be. But here, there are two approaches that we take. First, we were very sensitive to the fact that companies with different business cycles may need to go negative early in the year and need cash from one of their affiliates to kind of get through the cycle until they realize. So the classic case is you have a lot of expenses to build your inventory, but you're not going to get cash until you sell the inventory, get a receivable, and liquidate the receivable. That is not necessarily a process that takes place in one calendar or tax year. It might vary business to business depending upon that company's business cycle. So what we did here, you have really two alternative ways to use the cash pool exception. First, the money was lent for the short-term cash needs of the business, but we had to put a limit on it to say you can borrow that up to the amount of the current assets of the business, which would typically be your non-liquid receivables and things, and we've carved out current assets like cash and securities, things that you should not have to need to borrow if you have. So I'm going to say that we were trying to be responsive to the companies and the treasurers that came in and said, here's how we run the business. We have cash needs. Current assets is not a bad proxy for the amount of cash that a company might need in the course of a cycle, and we let it run for the business cycle, all looked at by GAAP and good business judgment. So we're not trying to be overly prescriptive or rigid here. And by the way, I would say that I think if there's a theme on the short term, it's a little bit of letting there be a little play in the joints so you don't hamstring this type of cash movement around a group.
So if a borrower had 100 million of short-term receivables and just always had 100 million through all cycles, so over a long-term basis, it had 100 million of short-term receivables, it could have outstanding rolling 100 million of short-term borrowing?
I think so. What I'm not 100% certain on is the interaction between the timing of when you measure those current assets and what your balances can be, and I just apologize. You see what I'm saying? Like, if your currents go down, I think it's the highest point of current assets during any year, but I'd have to go back and check that.
I don't mean to interrupt you, but just to, what form do these regulations take?
Yes,
Just to
thank you.
Are they temporary?
Yeah, so thank you.
And when effective, et cetera?
Yeah, so the cash pool regs are temporary regulations, as are the financial institution regulations. And I'm not 100% certain, but I think almost the entire rest of the package is final, and then, like in bifurcation, we just have no reg out there at all. So it's not a proposed reg, it's just something that we put to the side, for
Is
now.
that still on the,
So does
are
that
there
mean
things
that
still on the
these-
table then, or?
Yeah, would the temporary ones expire?
Yes,
Sorry.
yes, the temporary ones expire in 3 years, and if you're asking the logic of why some things are temporary, it's the areas where, as the Treasury and IRS get experience with them, people will have to come back to them and revisit them and kind of refine them because of the experience that taxpayers have, and that's kind of but just for the audience, temporary regulations have final effect. It's just that, as Lucy was pointing out, they will expire in 3 years.
But does that mean that if nobody does anything?
Thank you, the temporary proposed, yeah.
If nobody extends them, will then, say, a financial group become subject to the full?
I
Dash
do
three.
not know exactly, I just don't know off the top of my head.
So just to be
Yep.
clear, though, the bifurcation rules, practically speaking, are dead?
Yes,
Okay.
and just let me say a little bit why. First of all, the first rule, people correctly pointed out that there were concerns, particularly in practice like Lucy's, where the idea that you might look at a convertible instrument or in one of these New York financial instruments with all these bells and whistles and start to ask yourself, what's debt, what's equity, how do you bifurcate it, was not clear in the proposed regulations. But even when you got down to things like ability to repay for bifurcation purposes, we just were not there in time for this practice.
And also, just in terms of the scope of the rules, the way they worked before is that the -2 and -3 rules applied essentially to big businesses, defined in different ways. The bifurcation rule also applied to small businesses. So essentially, where you're left now is rules that only apply to large businesses.
Yes. Let me come back to just a couple of other points. You'll see throughout this that we carved out things like you might buy your parents' stock to pay stock compensation. You might have a receivable that arises because you had a transfer pricing adjustment. We tried to take into account the comments that related to what I think we would have all recognized would be foot faults, and we did not want to have a lot of, oh my goodness, there was this accidental receivable, or in a certain common circumstance where we could kind of turn the rule off. I would say that we did. Let me just talk, I'm going to end on -3 with two points. One is the timing, the effective date. So the regulations apply to debt instruments issued after April 4th, 2016. But interest doesn't get recharacterized under the rules until 90 days after the publication in the Federal Register, which I think I read tonight will be October 21. And at the same time, I won't say the way we said it in the proposed regulations, but if you enter into a debt instrument between now and 90 days after October 21, if I'm right about that date, you can undo that debt instrument. In other words, you can pay it off or somehow make it not be around 90 days after final. And the reason we did that was, obviously it's going to take people time to digest the regulations, and if you didn't have that flexibility, somebody could be doing a loan, on October 22nd in a big group, and we didn't want people to be caught that way. Last thing is we turned off the rules entirely for S-corp borrowers, RICs and REITs. Again, the flip side of that transaction with they're effectively pass-throughs, it mirrors the rule that we have for partnerships, with the exception that if the RIC or the REIT is part of a big consolidated group, which is, a larger group of companies, which it can be on occasion, then we throw them back into the mix. If you give me 1 second, I just want to see that I've caught the headlines.
Cascading, we may.
Say that again?
Cascading rule?
Oh, yeah, the cascading rule I can't talk about intelligently. What I,
Is it still there?
well, there's two,
It's been cut back.
well, there's three things you gotta know, thank you. So when you take out foreign to foreign, when you put in a cash pool exception, you have really removed a lot of what was driving cascading, particularly in the foreign to foreign context. The reason I'm punting is that there's kind of a couple of elements of the cascading rule, and they're each dealt with in very particular technical ways, because there is a type of cascading we think is completely appropriate, which is basically A borrows from B and lends to C. There are circumstances in which we think it's completely appropriate to treat all three of those transactions in our analytical framework and create stock between, let's say, 2 out of the 3. And then there are other situations where we don't. So I don't have them in my head, and I apologize, but that's dealt with in the regulations, 2 fact patterns that you can kind of play with till your heart's content. I just want to see if I'm leaving out any big things.
Can I just ask you a question?
Yes.
All the complaints about the 72 months,
Oh, yeah, yeah,
very mechanical,
yeah, thanks.
much too strict.
Yeah.
Is it still there?
Yes, and that's a really big headline, because there's a couple of points to make about this. First, if you think about the conceptual framework we're using, we've got 2 super factors, related party and no new investment. The cash somehow went someplace else. That is not really a purpose thing. We were always focused on the fungibility of money, and we were never really focused on, gee, can the person demonstrate that, the dog ate my homework? I really borrowed it in year 1, but oh my golly, in year 3, that somehow that 100 had to go back, and we're gonna fight with the auditors and have that big case in court, and presumptions and all that stuff didn't seem to speak to the issue to us, which is policing the round tripping of fungible money in a case where there's been a borrow. Number 1. Number 2, the 72-month window, I think we got a lot of comments to shorten it. Probably the biggest candidate would have been to go from 3 years on either side to 2 years on either side. Look, there's still a concern that with a 2-year window, people might have wanted to make create very large debts. They would have been content to earn some money on the cash until they could get it back. And so we simply stuck with the 3 years on either side. But again, taking foreign to foreign off, having a generous cash pool exception, we think it's a kind of a balance that the 3-year rule needs to be looked at in light of the other exceptions we've given, number 1. And number 2, I think it needs to be looked at in light of the fact that it really was never a bad purpose kind of rule.
So just to be clear, if you had a situation where a domestic sub made a distribution to a foreign parent and 2 years later the factory burns down, foreign parent makes a loan to build new factory, you can show very, very clearly that the loan is traceable to the use of money for the factory, you're screwed.
Yes.
Well, you should have had insurance, but, all right.
Sorry.
Mike has a question.
If debt is recharacterized as equity, is it recharacterized for all purposes of the code?
Thank you. So I believe there's one exception in 1504. There's a funny preferred stock recharacterization rule in A4 or something.
A4, yeah.
Yeah, we don't do it for that because we didn't want to make folks be deconsolidated. But for virtually every other purpose, again, I'm from memory, it will stay as stock.
So there's no rule,
Well, 902 goes away because with foreign to foreign turned off, there was a concern that if you turned debt into equity in the foreign to foreign context, it wouldn't be voting stock and you couldn't get a foreign tax credit. But that goes away when you turn it off for
but
foreign.
if you had a 351, for example, and you were concerned about whether you're meeting the control test and you
Yes.
had debt of a sub that was converted into equity, and that's not addressed.
Yes, actually it's addressed, but I think you
lose.
snooze, you lose.
Yeah, or control for external.
Right, control first.
Yeah. Just on a couple of these things, please go check me. It is 500 pages, and I didn't read it all last night, but that's my general sense of how those rules all work. And the theory is, you practitioners have that problem any time that you have debt in an entity where you're doing a 368C or a 351 transaction. it's not special just because we put in, these new rules. And by narrowing the circumstances in which they apply, we're less sympathetic to the idea that this is just impossible to keep track of.
Bob, I know you're time constrained on this, and we want to get some questions out here, but I think we give priority to student questions about this, if we had any questions from students.
Go for it.
Go for it. And you tell me when you have to leave.
Oh,
But
okay. Just have to-
otherwise, we're open to questions. I think, Peter, you had your hand raised, but.
I see one way in the back.
Oh, not. Well, that's the best we can do, so.
So question, under the proposed regs, and I think under the final regs, it's okay for foreign parents to lend money to US sub, and then US sub use that money to buy unrelated targets.
Yes.
But it was not okay under the proposed regs, if I'm remembering correctly, for foreign parents to buy targets and then transfer targets to US sub in exchange for a note. Because once target is acquired by foreign parent, it's a member of the same
Yeah.
group.
Yes.
That seemed a little formal because it's really just a question of which order of the steps you do it in. So
Yeah.
do the final regs
No,
say that both of those are okay?
No, that would still be the same. I mean, if you started to ask yourself in the first case, you set up a new code in the United States, you lend into it and it buys a target. If you started to say that that's not good, which from a policy perspective you might very well have wanted to, you then get into a place you might have wanted to say that's not good.
Well,
But-
but you said it was good, so I'm wondering if.
No,
the
no,
others
you're-
were-
No, you're right, but the problem you have analytically is you then need to decide an entire range of third-party type acquisitions. Remember, we said if you put the money in the US and use it in the US for investment, you're okay. If you started to say, if you acquire that target in your example, that's not okay, you do have a kind of a slope of issues about what assets that get invested in the United States that are good and which are bad. And that exercise is not intuitive or obvious. And so that's where we are.
Well, what it reflects is the basic issue that if you distribute a note from a sub
Yeah.
to the parent, that's bad. If you set up the sub originally and have debt capitalization, even though the end result is the same, that's good. So
But I guess
the
I'm
steps
confused
leading.
why it isn't also okay for, as part of a single plan, foreign parent to buy unrelated target and then transfer it to US sub in exchange for a note.
I just think it's a great question, because I think what happens when you're doing this work is you do set up a paradigm and you try to stick with it and not, because if you go down that road, I just think you're gonna get trapped with exceptions or make a mistake.
I also think what this demonstrates is the basic principle that form prevails over substance, and tax lawyers can add value.
And the
Well,
result is much
just
more
and just
generous.
remember,
That's what we
just-
were trying to
and
deal
just
with, I
don't
thought,
wake
in
up
these-
the next day and figure it out, which has happened to me occasionally.
And M&A due diligence is gonna get a lot harder, because you're gonna have to ask people, how things happened and what order they happened in and what year they happened in. I have a question though, Bob. Did you change anything about partnerships?
Yes, I mean, but basically what we try, and again, I'm from memory, but a couple of high-level points. One, we certainly wanted to avoid springing partnerships, let's say in a debt situation with a DRE, kind of situation. And we do have some detailed rules on, how the aggregate rules apply, but I don't have them all fresh in my head, I apologize.
Yeah, you had different approaches in the documentation rule of funding.
Yes, and
partnerships.
that's right, and I think we've tried to kind of marry those together so that we did not create springing partnerships in either place, but from memory, please check me, I'm not 100%.
Yeah, I think the documentation rules were the ones where you could have a springing
Yeah.
partnership
So-
because the DRE.
So one of the complaints about the funding rule also was that one of the triggering events is purchases of expanded group stock. And when you buy hook stock, there's something about that kind of seems artificial. If you invest in a downstream entity, it seems less artificial. And so there were some quite specific rules about that. Did you loosen up the kinds of stock purchases that counted?
Pretty much still a downstream okay. In other words, you basically did a 351, and everything else not okay. If there are more subtle differences, I don't have them in my head.
And the ordinary course exception, which was quite narrow before and basically covered sort of trade receivables, did that get expanded?
So in the -3 rule, what we did was we made it be ordinary course acquisitions of property, because only acquisitions of property get you in trouble in the funding rule. And so if that's what you mean, that's what we have in the ordinary course in -3. Which, while I'm on ordinary course, I mean, just going back to this whole EMP thing, I mean, one way to think about this with the EMP is you're really getting at not technically extraordinary distributions, but in the common sense meaning of the word extraordinary distributions, as opposed to just your routine distributions of your EMP, for example. A lot of ordinary course carve-outs throughout all the rules. I don't have them all in my head, but again, we're not trying to make people not be able to do intercompany trade payables and receivables and all that.
On the documentation, are you gonna have to show that debt can be amortized, or can it merely be serviced?
Well, I think we've remained somewhat vague in terms of what it is you need to do, on the theory that people can kind of figure that out. So I'm not sure we did a lot more there in terms of the specific guidelines that you need to demonstrate on that.
Did you clarify whether you intended to change the kinds of instruments that could qualify as debt or equity? So, for example, when you require that there be certain creditor rights, or that there be a fixed obligation to pay interest and principal, there were some questions about whether you were going to change recourse and non-recourse debt, and or were there certain contingencies that you would treat differently than under current law?
It doesn't ring a bell.
Okay.
I guess.
Yes? No, we have somebody in the far back there. May qualify as a student, I don't know.
Sure.
Yes.
And so I apologize, haven't gotten through all 518 pages yet. At least in the proposed reg, it was difficult to understand how that applies. It's even in your paradigm case, you have distribution of note, foreign parent subject to a 5% tax when you apply something at 0%. So, you are achieving a benefit by trading in stock, because now it's 305, you don't have the 5% tax, but you're losing the interest deduction. So, how did you apply that?
Yeah, from memory, and again, I apologize, but from memory, we kept the rule. We may have given a little more explanation of what the affirmative use may be, but I'm not 100% positive on that. We reserved on the no affirmative use?
You seem to have fixed the anti-abuse rule, so it can never apply to third-party debt. Is that
Yes.
right? Now, one sort of policy question. A number of commentators said that you should consider adopting some kind of leverage test, so that it wouldn't just the outcome wouldn't just depend on the mechanical steps that led to the creation of debt, but would also look to the financial condition of the borrower. Did you consider anything like that? I take it nothing like that is in here.
No, we considered everything. And I do want to take an opportunity to say, just again, we have a student audience, it's really been a remarkable process. We did get about 143 very serious detailed comment letters, and we certainly have an enormous team working through everything. And I just feel very proud of a process in which we looked at every comment and gave it its due, and really tried to think them through, and not just for APA reasons, but because it's the right thing to do, isn't it? So I think we did that. What was the question you asked? On which
The
particular?
leverage.
The
No,
leverage, yeah.
it's whether
So
you-
the preamble talks about all these different things about why, if you think about things like leverage tests or adjustments to 163J, I mean, the headline on all of those things is they do seem to step out of what you think of within the confines of distinguishing debt and equity in 385. And so we did not go as far as to superimpose an entire set of tests built around things like leverage, and this is all explained in the preamble, but basically the thinking was that was that took you to a qualitatively different place from the approach that we were taking.
Okay.
Over there?
Yeah, there's a question back there? Yeah.
I would have a question, foreign trained guy, I've been a student here now, my question would be, what is the impact on the double fixed treatment of the payment?
Yes, it's still a dividend. In other words, if it's debt and it turns into equity, you now have the unusual situation in which we've created a hybrid that probably has no deduction and an inclusion in the foreign jurisdiction that views it as debt. Not a happy result, but there we are. Mike?
If you have a US company with a foreign parent, and then the foreign parent is acquired, do you restart the E&P calculation again?
I don't know. I believe it keys off the parent of the group, but I just don't have that particular fact pattern in my head.
Do you recall if there was a fix to the problem about defining expanded groups? Because there was a concern before that if one group made a distribution to its parent and then that group was acquired, and there was a loan made to the new group, that these rules could be picked up
Yeah.
even though you didn't have the same expanded group on both sides?
So there's a lot of attention paid, there was a lot of attention paid to these expanded group definitions. I don't have them all in my head. And there's a lot of attention paid to successor and predecessor rules, which when you read them in the preamble, they're gonna make your head hurt because they're very abstract. And the regs try to do a better job. It's kind of common sense policing of the circumstances in which you'd want to do this. By the way, there's also a -4 of the regulations on how these apply, not within the consolidated group, because we turn it off in the consolidated group, but what happens when members leave the group and all that fun stuff that consolidated return people love. That's all in the -4 regulation, and it's also rather rough sledding.
Did that change very much?
I don't know. I know it got a lot of attention, and but I don't know.
Well, Bob, how many people were involved in this project?
That's a great question. I don't know. So Treasury, just for everybody's benefit, I mean, so in the International Tax Council, there's 13 of us, and then in Tax Legislative Council, I think they're a little bigger at Treasury. IRS has Associate Chief Counsel International. I'd never sat back and looked, but it's quite a group. And again, because I have a student audience, the people that worked on this, I have to say in my career, I've never worked with a group as talented as this in terms of the technical talent and ability, all thinking these things through together. It's really been actually quite humbling and impressive thing to watch, but it's been a very large undertaking.
There was a technical glitch that got commented on a number of times that the attribution rules could cause partners in a partnership
Yeah,
to be connected. I assume that was fixed.
Yes, that I remember.
Did you have a question?
Well, I just wanted to go back to the ordinary course payments that are allowed. That's a pretty limited rule, or it was in the proposed, and I gather from your comments that that's still.
No, there's some confusion on that. In the -3 reg, you only have a funding issue if you get a loan and then use it to acquire property. And so the carve-out there is for ordinary course acquisitions of property. If you're using borrowed money to pay a royalty or pay for services, you're not in the funding rule. And I think there was some confusion about the scope of the funding rule when people were saying, oh, and by the way, when I was going through drafts, I was stumbling upon the same issue. And we explain in the preamble that you only need a property out because it's only acquisitions of property that get you in trouble in the funding rule.
But it wouldn't hive off that particular cash. In other words, if there were a borrowing on the other side, it could still be picked up even though the cash in this instance was used for, or a dividend 2 years later. I think that might have been part of the request was if we're borrowing and using cash in certain ordinary course transactions, do we insulate that from being married with a different transaction later on under the funding rule?
Okay, I don't have that in my head.
Just to follow up again, when I said it was limited, it also was limited in what ordinary course is. So my understanding of the proposed rule was that if you were replacing a factory, as we have the example, or building a new one, that would be considered ordinary course, even though it was a very important aspect of the business.
I don't have the definition of ordinary course to that issue in my head. I would have thought of it as more, I would not have thought of that as ordinary course, but I don't know exactly how
Question back there?
Yeah, just to circle back slightly to the exotic treatment under the tax treaties. Is there any concern that this may sort of vitiate some of the provisions in those treaties and require a new round of negotiations?
No. And here's why. You've got two kinds of treaty, you've got two or three treaty concerns. One is who gets to determine what's a dividend and not a dividend? And that's the country making the payment, that's us. So we are clean in our treaties on the definition of a dividend and how we apply the definition of a dividend. The second type of treaty concern you get is anti-discrimination. And because we are applying these to domestic outside the consolidated group, we're confident that we don't have an anti-discrimination claim against the treaty. The third thing to say, by the way, is once you scrape away all the exceptions we've given and think about this, you shouldn't be accidentally falling into these rules if you're a major multinational dealing with your, let's say, U.S. parent and look up and go, oops, we have a $200 million stock that we thought was debt. And I think that's fair. Michael?
I assumed one of the original purposes of the regs was to go after 304 transactions by, foreign to foreign, where you ship B&P around among CFCs, but I take it that's not true because that's all gone now.
Yeah, I mean, I actually think there was some discussion of, let's say, repatriation in the original preamble, but I think that you're absolutely right that was a bit of a bridge very far for what these regs were going to try to do, so we've walked away from that.
Just ask a question there.
Yeah, right.
On that note, and to circle back when you were saying that the recharacterization date is now 90 days after the regs are published.
Yes.
For all instruments, does that mean that you now have a 90-day window in which you can do 3 or 4 transactions for a note or something else and have that note still be separate as well?
You pay it off.
You have to pay it off, you see, because
Before the 90 days?
yeah, before the 90 days, and that's right. Yeah. Yes, in the back.
Did you have meaningful internal dialogue about the provision of these accommodations, like the ability to take out, I understand, earnings accumulated after the proposed reg promulgation date, free of the -3 regs, whereas if you try to do the same with respect to antecedent E&P, you have a problem. That line in the sand kind of gives rise to a possible arbitrary. It's arbitrary in how I determine debt equity with respect to a company has accumulated earnings before the date, and a mirror company in mirror situations has earnings that have come only after that date. And so the APA, there's obviously a much more heightened sensitivity now to that. But there's more to the APA than just responding to taxpayer criticism. There has to be a proof that what you're doing is rationally related to the advancement of your permissible policy objective. And some of these accommodations, whilst they'll be welcome, they seem to possibly be a double-edged sword in the sense that they possibly are, they present further indicia of arbitrary conduct on behalf of the rulemaker.
Well,
Is there a struggle around it?
so 2 points. One, if you put out a proposed regulation that said there's a new world today, every debt instrument that comes out after today is subject to a regime that they hadn't been subject to before, that tells you that date is a significant date in the life of this regulation. And to then say your earnings and profits earned after that date can be used to repay debt instruments subject to these rules after that date doesn't strike me as irrational. And as I said earlier, remember, we are also letting go a debt issued on April 2nd that was before the date. And so those people are out from all aspects of the rule with respect to things that happened with respect to that note that was issued. So I'm not particularly worried about that, although all of our internal deliberations try to get at those kinds of things. One thing before I leave, on some of the technical nits, go back and recheck me on the regs because I don't have every bit of this 500 pages completely in my head. So I just want to say that. Obviously the headlines I got, but I'm getting some cool, weedy questions here. But anything else?
Your
Yeah.
time constraint.
Yeah.
Well, Peter, you want to say something about? We've probably time for one more question, and then Peter.
Okay. One more question. Oh, Pete, you have one.
I
Yeah.
have one.
Okay, sorry.
Just, were you surprised at the response, the comments that you got about the original regulations? And looking back on this, is there anything you would have done differently?
That's a wonderful question. So,
Introspective,
Yeah.
soul-searching kind of question?
Well, it was wonderful for the, in April of 2016 was a rather boring point of time, right?
it wasn't for me.
There wasn't much
And it was 3 days
legislation.
after April Fool's Day.
We
so-
were all sort of asleep at the wheel, and then all of a sudden, here we go.
I think, I'll say it this way. As I said earlier, we started out with a 385 rule that was doing debt equity everywhere you could find it. And then the tax community came in and really did have two reactions. One is, there are a lot of people in the business community that think it's their God-given right to be able to manufacture deductions at will everywhere in the world. And they were just, offended that we would dare challenge that. So that's one part of the comments. But the rest of this kind of like, wait a second, foreign to foreign, 902, why are you doing this? We got all good comments. So I actually think it was energizing. I mean, look, we've got a lot of really smart people that came into us and made really, really good presentations, and we tried to absorb them. So I have learned in this job a long time ago not to take it personally. And so I represent taxpayers. We do our thing. We try to react in good faith. So I think, just to give you one little example, when you did the foreign to foreign, and then companies, and this is how you learn in a regulatory process, when companies come in and say, I have 4,000 foreign subs, and I don't even have a system necessarily that helps me figure out which ones are distributing to which ones in my web of companies on any given day, you learn something and you try to incorporate that into your thinking. And I think we did learn things that I didn't know before, and we tried to do it. So that's one way to answer.
Peter.
Okay. The other thing about the regs is they were top secret for 18 months, right? Before April 4th, right?
What do you mean
Nobody
by
really
top
knew what was going on.
Who?
Well-
Within the government?
Outside of the.
Well, the public.
Oh, with the public, yeah.
Yeah, so it really was a secret for 18 months. So April was a big surprise for everybody.
Yes.
Okay, thanks, Willard, for organizing this, and Bob for the comments, and Jim and Lucy for just your great dialogue throughout the panel. This is the fourth presentation that we've had like this. We've had one on treaty issues, one on inversions, and one on BEPS. And we organize these based on the summer seminars that we have at IFA in New York, which is, as Josh said, one of the largest chapters of IFA worldwide. IFA itself is an international tax organization. It's the largest in the world. There are 10,000 members. We have lots of meetings, lots of events. It's a great forum for gathering information about international tax. It's also a great forum for networking. In New York, we have 2 seminars plus the annual branch meeting, which it moves around in the U.S. Students can come to the New York meetings for free. So keep that on your radar screen. They're usually in July, and this year we're having one on December 2nd. They're great. And once you're a member, you have access to all the materials on the website. So it's really great information. The last thing I want to just point out is that we do have a writing competition for students. It involves a paper of significance on an international tax topic. The winner receives a $2,000 prize and an all-expense paid trip to our annual meeting, which next year will be in Houston. So I encourage all of you. Well, it's not Barcelona, right? You want there is another one that actually is at the big IFA level that gets a free trip to wherever the Congress is, where next year we'll be in Rio. But in any event, I encourage everybody to take a look at that, students anyway. And thank you again, panelists, Bob and Willard, and see you next week.
And I just wanted to reiterate our thanks to the panel and to IFA for hosting a reception, which we will now have on the 3rd floor of this building in the faculty library. Also, one last quick note I wanted to mention, there is an NYU connection. Bob mentioned the article by William Plum called The Federal Income Tax Significance of Corporate Debt. It was published in Tax Law Review in 1971. It was actually edited by our own Professor Victor Zonana, who's here tonight. So there's lots of NYU influence, hopefully, in these regs. Thanks very much, and we'll be on the third floor for the reception. Thanks a lot, Will.